today, nowhere to hide as the markets fall on normal monetary policy. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and proper news with a distinctively Australian flavour. And just before we start, a quick reminder that at 9 to 8 p.m. Sydney time, I'll be joined by Leith van Onselen. And we're going to be talking about where the current economy in Australia is going, recent government policy, and specifically housing. So you can ask a question live. Join us at 8 p.m. Sydney. Well, rough seas persist for the markets now, and while long-term investors may be doing some buying, the 10-year Treasury continues to put downward pressure on stocks, and there is more to come. The US Federal Reserve warned of deteriorating liquidity conditions across key financial markets amid rising risk from the war in Ukraine, monetary tightening, and high inflation in its latest semi-annual financial stability report, which was published yesterday. It's important to understand that market liquidity is a measure of the ease of buying and selling desired quantities of an asset and is an important indicator of how well the markets are functioning. The report said, according to some measures, market liquidity has declined since late 2021 in the markets for recently issued US cash Treasury securities and for equity index futures, and this is before the Fed formally starts its balance sheet reduction program. While the recent deterioration in liquidity has not been as extreme as in some past episodes, the risk of a sudden significant deterioration appears higher than normal, the report said. In addition, since the Russian invasion of Ukraine, liquidity has been somewhat strained at times in oil futures markets, while markets for other affected commodities have been subject to notable dysfunction. And among other findings, it says that households and businesses have decreased their borrowing as a percentage of gross domestic product and currently appear to have resources to cover debt burdens, which is an important aspect of resilience in an environment of rising interest rates. Russia's unprovoked war in Ukraine has sparked large price movements and margin calls in commodities markets and highlighted a potential channel through which large financial institutions could be exposed to contagion. From a financial stability perspective, since most participants access commodities futures markets through a large bank or broker-dealer that is a member of the relevant clearinghouse, these clearing members are exposed to risk when clients face unusually elevated margin calls. Now, this is one reason why the S&P 500 ended below 4,000 for the first time since March 2021, and the Nasdaq dropped more than 4% on Monday in a sell-off led by mega-cap growth shares as investors grew more concerned about rising interest rates. Tech, meanwhile, struggled to find its footing as investors appear wary of buying the dip, even as Treasury yields did take a slight breather. The Nasdaq closed at its lowest level since November 2020. Apple shares dropped 3.3%, and they were the biggest weight on the Nasdaq and on the S&P 500. Meta, Google parent Alphabet, and Microsoft were all down more than 2%. The selling in Microsoft took its valuation below $2 trillion for the first time since June 2021, and Amazon slid more than 5%. Twitter shares fell more than 3% as Hindenburg Research took a short position on the social media company's stock, saying the company's $44 billion deal to sell itself to Elon Musk has a significant risk of getting repriced lower. Investors are worried about how aggressive the Federal Reserve will need to be to tame inflation. The US Central Bank said last week that they needed to do more and hiked the rates by 50 basis points. Benchmark 10-year Treasury yields hit their highest level since November 2018 early in the session. It ended down a little at 3.038. The 2-year was down to 2.610, but there's little comfort there. Markets are digesting the start of return to a more normal monetary policy environment, said Christina Hooper, Chief Global Market Strategist at Invesco in New York. Moving more aggressively on rates raises the specter of a recession, especially with all of these complications: high inflation, Russia's invasion of Ukraine, COVID-related supply chain disruptions, she said. Investors have also been worried about an economic slowdown in China following a recent rise in coronavirus cases. Dow Jones Industrial Average fell 1.99% to 32,245. The S&P 500 lost 3.2% to 3,991. And the Nasdaq Composite dropped 4.29% to 11,623. Among this hardest hit in the recent sell-off has been the technology and growth stocks, whose valuations rely more heavily on future cash flows, which of course are now discounted because of higher rates. The energy sector fell 8.3% as oil prices dropped, and that was pressurized by a stronger dollar and fresh fears over weakening demand from China as Shanghai reportedly intensified COVID-19 lockdown measures. WTI was down to 102.76, that's a fall of 0.32%. The recent China lockdowns are expected to slow growth in the world's second largest economy and adds to fears of a significant slowdown in the global economy at a time when central banks are on the road to tightening monetary policy to rein in inflation. The COVID-0 policy in China has throttled household spending and has not left the productive side of the economy unscathed, Morgan Stanley said. The risk of an extended contraction is plain to see, it added. The earnings front didn't offer much help either to improve investor sentiment, as Palantir Technologies plunged more than 21% after reporting quarterly results and guidance that fell short of analyst expectations. However, in some brighter news, BioNTech bucked the broader market trend lower after its better-than-expected first-quarter results sent its shares up more than 2%. Uber Technologies, though, fell more than 11% as the ride-hailing company reportedly plans to scale back hiring and to cut its marketing and incentive spending, according to CNBC. Crypto-related stocks, including Coinbase, Marathon Digital, and Riot Blockchain, were all down double digits after Bitcoin fell to its lowest level since June. And in a sign of the negative sentiment on Wall Street, consumer staples, that's a defensive corner of the market, closed just above flatline. Consumer staples, defensive characteristics make this sector potentially attractive during market volatility and as the economy slows, Wells Fargo said. The move below the key 4,000 level in the S&P 500 could pave the way for further pain, though the latest slump in the broader market has pushed it further into potentially oversold levels that may trigger a short-term rebound. But then, of course, the question is, how do you value stocks in this market? The move today is bearish, obviously, and sets our target range of 3,600 to 4,000 ahead. However, we would note that stocks are now very oversold and could easily produce sharp counter-trend rallies in sessions ahead, maybe upwards of 6 to 10% from the lows, January Montgomery Scott said in a note. Gold also slid down 0.25% to 1,853.85, while silver drifted lower to 21.80. And the US dollar index remained strong at 103.72, and as a result, the Aussie was down below 70 cents at 69.50. Australian shares are poised to extend their losses with the S&P ASX 200 fast retreating. And as I record this, the ASX 200 is down to 6,942. That's down more than 2.44% and will probably drop a little more. Bitcoin dipped more than 10% to touch lows of 30,094 amid protracted selling. And amid the broad sell-off, Bitcoin set to mark its fifth consecutive day of losses, consequently setting new record lows for 2022. At the same time, the second biggest cryptocurrency, Ethereum, fell more than 10% to touch lows of 2,251. Ethereum is now down more than 35% from the start of the year. Alternative cryptocurrencies, otherwise referred to as altcoins, even suffered a harder hit, as most posted double-digit losses according to CoinMarketCap data. Solana, Terra Luna, Cardano, and Shiba Inu, and several altcoins, especially in the top 100, have recorded losses between 12% and 19% in the last 24 hours. And according to CoinGlass, there have been nearly $725.34 million in liquidations across the crypto markets within the last 24 hours, albeit cryptocurrencies such as 1inch, Waves, and Near Protocol did manage to suppress the selling pressure slightly and were trading in the green, at least for now. Cryptocurrencies have been slowly deepening their losses since May the 5th, when they plunged abruptly amid a broader stock market sell-off in which the Dow Jones Industrial Average and the Nasdaq Composite experienced their worst single-day dip since 2020. Losses, however, steepened as additional sell-side pressure was generated. For over a year now, the crypto market, driven by Bitcoin, has remained closely connected with equities, and on Monday, all three main stock indices were down. Bitcoin has followed the lead of the equity market, extending lower after a weak April, said Katie Stockton, founder of Fairlead Strategies. Short-term momentum has deteriorated and Bitcoin is no longer oversold from a short-term perspective. Even though $30,000 is a popular floor level among crypto pundits, some fear Bitcoin might fall below $25,000 or even lower. Crypto analyst Matthew Hyland sees Bitcoin reaching $28,800 next. Meanwhile, veteran trader Peter Brandt earlier predicted that Bitcoin might be due for a severe correction, with the price dropping to $27,000 in the near term. Frankly, nobody knows. That said, the government of El Salvador, which was the first country to make Bitcoin legal tender last autumn, has continued its Bitcoin buying spree with the purchase of an additional 500 tokens for roughly $15.3 million, and the average price they paid for each Bitcoin was $30,744. The price of Bitcoin has dropped over 10% now to $31,053 over the last 24 hours. So the question is, where to from here? It is ending as fast as it began for retail day traders whose crowdsourced daring was the preeminent story of pandemic equities. Nursing losses in 2022 that are worse than the rest of the markets, amateur investors who jumped in when the lockdown began have now given back all of their once prodigious gains, according to an estimate by Morgan Stanley. Calculation is based on trades placed by new entrants since the start of 2020 and uses exchange and public price feed data to tally overall profits and losses. A craze born of the coronavirus outbreak and nurtured by US Federal Reserve largesse is being laid low by a villain of identical lineage, inflation, which global central banks are racing to combat by raising the same interest rates they cut. The result has been a lumbering bear market in speculative companies that surged when the stimulus started flowing in March 2020. A lot of these guys started trading right around COVID, so their only investment experience was the whacked out Fed-fueled market, said Matthew Tuttle, chief executive at Tuttle Capital Management. All that changed with the Fed pivot in November, but they didn't realize that because they've never seen a market that wasn't supported by the Fed. The results have been horrific. So could the DIY crowd bounce back? Well, it could be. People have been foretelling the death of the 2020 vintage retail investors since the moment they surfaced. Past reports of the demise were exaggerated. Armed with zero commission trading accounts, individual investors have managed to will their favourite stocks back from the brink multiple times, and it may be able to do it again. But famous names from the height of the frenzy are nursing serious losses. AMC Entertainment is down 78% since June 2021, and it's lost 49% this year. Peloton Interactive is off 90% from its record. And from the start of 2020 to last November, a basket of retail stocks favoured by retail trades that Goldman Sachs tracks more than doubled. This year, that basket has plunged 32%. That's more than twice the S&P 500's decline. So it's an epic fall from 2021, when all home traders shot to fame after banding together on Wall Street Bets forums to try to squeeze professional investors out of short positions and otherwise overthrow the Wall Street order. Retail investors accounted for roughly 24% of the total stock trading at one point, according to data from Bloomberg. Their influence made Reddit blogs and stock twits posts must-read material for anyone gathering intel in the markets. In 2022, when about $9 trillion has been raised from the value of US equities, the day trader army has held relatively firm, at least in terms of positioning, which contrasts with professional money managers who've been retreating. Hedge funds, for instance, have been cutting risk for months, spending their equity exposure to a 2-year low, according to data from Morgan Stanley. For investors looking for signs of a market bottom, retail behavior is something to watch. And according to Morgan Stanley, the traditional capitulation is typically marked by a quick degrossing by hedge funds plus systemic macro strategies where positioning is already light. Instead, the next leg of de-risking is likely more gradual, coming from asset allocators' real money retail and therefore likely slower to play out, making a precise bottom call more difficult. There are signs that day trader crowds are souring in the market, and in April, retail investors snapped up $14 billion worth of stocks, the second slowest uptake in any month since late 2020, said Morgan Stanley. And in the options markets, where they used to rush to bullish calls for quick profits, activity is now tilting towards bearish puts. But the point here is that no one knows where the downside here is. We know that the Federal Reserve and other central banks will continue to lift rates until they break something. And of course, the value of stocks are hard to detect in this environment. So therefore, a time perhaps to sit on the sidelines like the professional investors and just wait to see what happens. Certainly, any dead cat bounce will be, I think, pretty short and to the point, but the overall trajectory will be lower and lower, I think, for some long time yet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.